Keith, welcome. Keith is a partner at Founders Fund, prolific investor in DoorDash, firm, PayPal Mafia member, and this is called the Provocateurs, I think, so no pressure on us at all to be interesting, but I just was reading through Keith's Twitter feed, which is a constant font of conflict and ideas about interesting things to say, so I'm pretty confident we'll be okay. So I think one of your most interesting comments lately was you predicted on November 19th a market top. You said there would be like a 25% tech correction. We've seen some of that. What was your thinking at the time?
So the funny thing is, predicting market corrections is actually really easy. Like, everybody values businesses the same way, from first-year MBA students to very sophisticated publicly traded companies. They basically take a cash flow projection for the next 10 or 20 years, and they divide by some discount factor, which is a function of risk and interest rates. So all you have to do is change the interest rate that's assumed in the model, and because it's discounted over 10 or 20 years, it massively changes the valuation instantly. And so you don't have to be super fancy, super intelligent or anything. You just have to figure out what's going to happen to interest rates, and it's been very obvious that interest rates are going to go up for the last year. Anybody who didn't believe the inflation is transitory nonsense knew that interest rates were definitely going to go up. So as soon as you figured out that interest rates were going up, you just change your variable in an Excel spreadsheet, and every company in tech is worth somewhere between 1/3 and 75% less, just instantly as a function of a spreadsheet. So all I did is basically divide by 3, because interest rates are clearly going up.
And as an early stage investor, do you do anything differently, or it's just sort of like, well, at the end of the day, I need to now you're competing against Tiger Global, right, which is doing, I think, Series A deals at this point. I mean, there's so much competition. Do you adjust your pricing if you think, public valuations are going to go down?
Well, so I personally like to specialize in seed and Series A investments, but as a fund, we run a venture fund and a growth fund. So I'm involved in a lot of growth investment decisions at a minimum, and sometimes occasionally lead a growth round. So the growth fund competes with Tiger, Coatue, Sequoia, Andreessen Horowitz's growth, et cetera. And we have to be consciously aware of how other companies, other entities, funds, Coatue, G1 are going to price things. On the early stage side, not really. I don't really compete with any of those people. I certainly don't compete on the basis of price. So it depends on what hat I'm wearing. So you have to remember, every meeting you do with a founder, what round is this, and then what's the likely competitive landscape. So the ideal for me is to find a seed company, keynote deck, no metrics. There's no way hedge fund people are investing in a PowerPoint or a keynote deck. So now, that said, you can't deploy $1.4 billion of venture capital and $1.5 billion of growth capital every 2 or 3 years just on seed decks. So to some extent, yes, but it is a function of what's the round and what the landscape looks like.
If you want a company, you'll pay the top price, or you're willing to hold out and say, no, I don't want to be seen as somebody who pays whatever the market price?
It's been an evolution. So I've been a professional investor for 8.5 years. I think I started with a more naive and traditional approach, maybe the first 5 years of my career, of I want to be disciplined on the basis of price. And I kind of really didn't understand this point that Peter Fenton used to make, which is that price is always a trap. This is his exact quote, and that you should pay, the valuation is just an excuse for not doing a deal you don't want to do. And then somewhere between years 5 and 7, the logic of what Peter was trying to say started occurring to me. So now if I really want to invest, it's like an acid test of how much do I want to invest. But if I really want to invest, there's a zone of limits, but if it's in that zone, I don't really care. I do tell founders all the time, though, there's a zone. And once you're outside that zone, I don't care if there's 26 people in the world that'll pay outside that zone. I just can't and won't do it. Okay,
so another theme of your Twitter feed lately, well, you like to argue about Miami versus San Francisco crime rates.
Well, there's no argument. It's just like walk outside. I mean, that's all you need to do.
He tweeted the other day that anybody who's anybody will be in Miami for these 2 weeks. So congratulations on being somebody, I guess, got me. But yeah, why this? What motivated you to go sort of all in on Miami, and explain sort of your aggressive tweeting on behalf of Miami and against the city?
You interviewed me. Basically, I moved here a year ago, or 1 week, almost a week away from a year, and the argument's the exact same as when you interviewed me like a year ago, which is the Bay Area is broken and getting worse. California is broken and getting worse. And people should find a place to live that they actually enjoy, that their spouse and would be proud to raise a family. And in the United States, if you apply a simple set of criteria, safety, weather, cosmopolitan, diversity, proximity, like international airport, there's really only one choice, which is Miami, if you say ex-California. And so it was a no-brainer, personally, for me and my husband to move here. That was easy. There was questions about should we move outside the U.S., et cetera. But if you're going to say we're going to stay in the U.S.
You sorted for good tax environments, and then...
Well, we had a maximum tax of like a reasonable tax rate of, let's say, call it 4.5%. I think, so we weren't going for zero, but we wanted like... Tax rate is a symbol of, is the state well run? Are they disciplined? Do they think about return on investment? So we didn't really have to exclude anything on the basis of taxes that we would have otherwise considered, but we basically said 4.5. So like you could have moved to Virginia, Texas. I think Arizona still qualifies. Seattle and Washington just went above that threshold. But there's a lot of choices. But fundamentally, warm weather definitely filtered some things more than taxes actually did.
Barry's boot camp, I guess inside.
There was a Barry's requirement, but they've been expanding pretty well.
Yeah. How much have you sort of worked with the existing ecosystem? I mean, we've heard a lot from sort of the local Miami crowd. Have you spent a lot of time there? Or it's still sort of the same network that's totally distributed? Or how do you think about?
I'd say it's actually neither, which is I'm not really looking, to find great historically based Miami companies. If there are, if I find them, great, I'll pull the trigger. And on the other hand, I'm not like actually using the same network that I was using in the Bay Area. One of the best things that happened was actually moving here. It sort of forced me to clarify and get out of complacency. So when you've been doing something for like 8 or 9 years and it's working, you tend to do the same thing. Your schedule every week, your schedule every month looks a lot like the calendar of the month before. And so you meet the same people, you find the same relationships. So when I moved here, I started taking a widely different and divergent set of meetings. There's more blending in Florida and Miami, particularly of industries. So I started meeting with a lot of people who were in real estate, in entertainment, in art and design. And my calendar suddenly had maybe 30, 40% of people that were not traditional tech investors or not traditionally in tech. And they had access to and information about the up-and-coming trends, up-and-coming people. And so I had a completely different schedule than actually the first 20 years of my career.
Just following up, are there particular, like the NFT boom, I think you say you've been talking to a lot of artists. I think of NFTs. Do you have a view on them, or like what are you excited about sort of as a next sort of technology?
Sure. So let me take a step back. One of the things that's most interesting about Miami is how culture here in art and design, particularly in entertainment, blends with technology, which I think is the future. Basically, as software is eaten industry, using the proverbial Andreessen formulation. I think the next wave is technology and art and entertainment blending together to reinvent society. And Miami's a perfect place to do that because we're the center of art and design in the United States, arguably New York too, but basically modern design and art is here. And if you could fuse that with technology, it's the future in the U.S. Arguably, you could do the same thing in South Korea. There's a lot of design and pop culture that could be blended with technology. But in the U.S., Miami is the easiest choice. So I've been looking for opportunities that are at the intersection. Specifically around NFTs, we made a major seed investment in a company called Royal, which is starting with music and primarily reinventing the music industry using a combination of NFTs and Bitcoin technology. Or blockchain technology, let's say.
And then Open Store, I didn't even realize until I just saw you that you're the CEO of a company on this side, which I didn't even introduce you. So what's the story with Open Store? That's a bit, you just told me you had like 30 some employees now. Yeah. Are they in Miami?
Yeah,
Are they
so
all
they're all
here?
in Miami. So I had this thought. It was a little bit right after you interviewed me. I think I might have alluded to it. But if I was proselytizing that Miami's the best place to build a tech company in the next 10 years, the logical corollary is I should build a tech company in Miami and prove that to people. So I started a company March, conceptually started the company like the day before Christmas was really when the idea was sparked by Jack Abraham of Atomic, but committed to doing the company early January and then really put together the core team in March. And then we launched in July-ish. So we have about 37, 38 employees all based in Miami. We all work together in the office every day. The basic concept is we provide liquidity to long-tail Shopify merchants. Obviously, Shopify has been a heroic success story over the last decade. Notwithstanding politicians' belief that Amazon has all this monopoly control, Shopify is the tech story, probably with Tesla over the last decade. And so these smaller businesses on Shopify, the million smallest businesses, aren't going to raise venture capital. They're not explosive growth opportunities. Most people, banks certainly don't want to provide debt. So they're really capital constrained. And the owners and proprietors may not want to run the business for the rest of their lives. So what we do is we offer instantly, basically same day, a price to buy out the owner, take over the business.
If they're not venture scale or venture growth, why would the company that bundles them together be?
Well, we could buy hundreds or thousands or tens of thousands. There's 1.7 million businesses on Shopify that do less than $10 million of sales. So collectively, it can be a quite fascinating business.
And it's just like, what's the technology component, just that you're sort of so efficient at rolling them up?
Well, the technology component is we instantly underwrite. So think Opendoor instantly value a house, or Square instantly underwrite a very long tail business. So before Square in 2010, if you were, let's say, a personal trainer or a taxi cab driver or selling less than $100,000 a year, it was basically impossible to get access to Visa, MasterCard, or Amex. And Square made that instant. We approved 93% instantly. So we can underwrite and value a business sight unseen. We'll give you an offer within 24 hours and allow you to have money call in less than 2 weeks.
So I want to go back to sort of the Twitter theme. And just, I mean, you've always been someone, not to flatter you, but who's been able to stand out in venture capital and sort of this, what now more than ever feels like sort of a commodity market. I mean, when there's abundant capital, you know, you're picking a person. I don't, do you ever worry that like the fight you happen to randomly pick one day on Twitter is going to piss off like the founder who could make the next $1 billion unicorn that you could have invested in? Or how do you weigh sort of where to really be out there in a way that could turn off a company that you might want, a founder you might want to invest?
The founders I want to back want people that can think from first principles, and they want people who will tell them when they're wrong, or at least ask them questions to probe the clarity of their own thinking. And if they don't have those characteristics, truthfully, they're not building a $10 billion business. I know a lot of founders who've built $10 billion plus businesses over the last 20 years, and all of them have exactly the same characteristics.
What are the,
they are internally paranoid, but they can project externally reality distortion. They want people who challenge them because they don't want to make a mistake. And they can think for themselves. They don't, by definition, no one becomes a founder of a great company if they believe consensus views. Because all these companies, when they're founded, sound absolutely absurdly ridiculous. You forget sometimes how heroic the exercise is of building a company, the two proverbial kids in the garage that change the world or change an industry. Think about how insane it is from a rational perspective to wake up one morning and say, you know, the whole financial services industry is broken, and I'm going to fix that with my best friend from college. Or the world needs this, and we're going to totally change the how everything's communicated, how the news industry works, how society works. But this is what founders have to do. And so that characteristic means they want people who think for themselves around them. They don't want just people who, nod their heads and say, oh, that's great.
And I mean, what's your read on sort of the media environment at the moment? Like, are you I mean, obviously, I have a newsletter. I should promote it, newcomer.co.
I think I subscribe.
Where you gave me an interview, which I really appreciate early on. Anyway, but I don't know. Are you a go direct person, or do you sort of buy the Andreessen, like, we need to cut out the press altogether? You've been someone who's understood the media and watched it evolve. Like, what's your read? I guess, like, limit it maybe to the tech press and, like, what your view is on sort of the media today.
It's a great question. I think a lot of the Balaji, Andreessen Horowitz argument resonates with me because I think there's a lot of distortion and snark in the media. And, one anecdote to that is as you have your own distribution, which tech people and tech platforms have created, whether it's Twitter, Reddit, et cetera, taking advantage of that so you don't have an intermediary filtering your message can be really attractive. Now, not everybody has distribution. So like when I talk about our music company, one of the reasons why record labels are archaic is they used to provide distribution. So when I was growing up, the only way you could find like a cassette or a CD in a store was some record label had arranged that. And you'd get exposure to new songs and new artists on the radio, which they had also arranged. These days, artists, whether it's on TikTok or Instagram or Twitter, have followings, so they don't need a label to arrange distribution. They have great direct relationships with their fans. And so I think that's also the potential future of tech. I mean, I think it's impossible for me to read the New York Times.
It's less of a function of who's good. It's just like, do they still have their grip on distribution? If you can distribute yourself, then put out your own message.
I do think that there's a unique voice. I mean, I've been a fan of stratechery since the very beginning. I used to interview people, and especially people that wanted to transfer into new roles. And if they didn't read stratechery, it was basically a non-starter for me to hire them because it meant they weren't intellectually curious. So I think if you have Bill Simmons in sports has a unique voice, there is no substitute for reading his stuff on sports. So if you have your unique angle and insight, then there's definitely demand. And I think charging direct may be the better model.
All right, I could talk to Keith endlessly. We've covered a bunch of topics, but we've hit time. Thank you very much.
Pleasure to be with you.